watching Property TV.
Hello and welcome to Property Summits, the must-watch show for property investors and developers alike. I'm Emma Birchley, and with me today are 6 experts at the top of their game. First off, Richard Bush, a man who turned a personal interest in crowdfunding and peer-to-peer lending into a professional passion, co-founding Crowdlords, which pools resources to enable more people to benefit from investing in property. Next to our newest member of the team, Ranjan Bhattacharya. He's an investor, YouTuber, mentor and all-round authority when it comes to the world of property. So too is Nicholas Wallwork, a seasoned property developer, investor and author, as well as being CEO of the world's largest international property forum. Also here is John Howard, a man who's bought and sold more than 3,500 houses, apartments and developments in the UK during his lengthy career. Tony Gimple joins us too, a man with 40 years in the business who's a leading advisor when it comes to tax planning. And last but most certainly not least is best-selling author and serial entrepreneur Paul Mahoney, founder of Nova Financial Group, providing property investment advice with a particular focus on the buy-to-let sector. Hello, gentlemen. So today we're talking finance, aren't we? And Richard, this is your area. What happens if the banks say, nope, no more money? Where do you go?
One of the things that's happening at the moment is that banks are limiting how much they're lending on a project, whether it's a buy-to-let, whether it's a development. And there was a time when that would be 75% of the value. It came down to 65%, and for many people it's 60%. It's rare that someone's got enough money in the bank to pay the other 20% that they need to fund the development. So where do you get it from? You can either borrow it from a platform like ours or from friends or family, or you could get them to invest into the company that's doing the project. And I thought it was worth us discussing what's best. Is it better to get debt or is it better to get equity? John, we've discussed in the past, I know you hate leverage.
And disagreed on occasions, Richard?
Well,
Not always.
No. You tend to see my point of view in the end.
I do in the end, yes.
Persuasive.
You have a preference for debt, for equity, don't you, over debt?
Absolutely, I do, because I just feel that, you know, you might argue from the old school where in the old days you couldn't borrow more than 50% of the purchase price and you couldn't borrow more than 50% of the build costs. Now I appreciate all that's changed, Richard, and to be honest with you, it's pioneers like you who have changed that. And in a strong market, in a good market, that is no problem whatsoever. But like you said, coming forward, that might change slightly, and you know your type of organisation can help, can't it?
Yeah, but the difference between whether you borrow the money, whether you take the money in as equity or you take it in as debt, you still have to pay it back.
Sure.
You know, when you do a joint venture, for example, you might put the money in as a loan or as equity, but you expect to get paid back.
Sure.
And you look for a personal guarantee, perhaps, to make sure you get that money back. So what difference does it make whether you get that money as debt or you get that money as equity for you as a developer?
For me as a developer, when we work with people on joint venture fund, where we help fund the development, we share the profit with them, is that I'm getting involved on a day-to-day basis. So that's slightly different. I don't think that's a fair argument for you, Richard. And I'm trying to be generous to you there, because I think it's like our model is slightly different to most people's. But what does concern me, and I don't know how the rest of us all feel, is when you have a first-time developer, especially, who says, "Oh, I've got my investors investing in my development." You think, my goodness, you know, you don't know enough about it yourself before you start persuading other people to join you. It's to me, it's madness. They're far better to come to a financial organisation to get the money, who are going to, you know, give them strict guidelines rather than have a free-for-all with people who don't know what they're doing.
There's nothing worse. I mean, we often see developers that are raising money from friends and family, and they're raising it as debt, and they're paying 1% a month because people think that's generous. So 12%, yet they're taking all the risk. And it's just ridiculously low return that they're paying.
And that's the problem, I think, the friends and family, because they don't understand what they're getting involved in. Where if the main lender is giving 70% typically, and they've got first legal charge, so they're first in the queue. If it all goes belly up, they're first in the queue. So the friends and family, they're getting the 1%. They don't realise they're second in line to get their money back. And that can be a massive problem. And the other problem that's happening sometimes is that some developers have no skin in the game at all. So they're borrowing either from the main lender, then getting some debt and some equity. And if you've got so little skin in the game, if there are problems and building costs rise, we've talked about that a lot, then it's just as easy for the developer to just hand in the keys and walk away.
There's no incentive for them
That's
at
the
all. If it all goes wrong,
finish.
there is absolutely no incentive, Richard, is there?
That's the trouble.
That's not true, because I think that was true 8 to 10 years ago. Now every senior debt lender takes personal guarantees.
No, I think we're talking about.
We're talking about the people that
have skin in the game.
Yeah, I think we're talking about the family members or friends who are lending to these first-time developers with very little experience. Not only will they not potentially get their money back, the friends of family and friends, and by the way, there won't be much friendship after that. But certainly the person who's doing the development will get nothing out of it.
This is exactly it. I mean, the main lender is reasonably well secure, but there's been a publicised case of a company that's gone down owing 17 million to private individual investors that have come in after the bank, and they've basically walked away. And these things are happening.
And didn't know how much had been invested by other private individuals into that project. That's the other issue.
Yeah, so the leverage was over 100%.
Yeah.
Do you think
130%.
sometimes when people might need that 30% and they think, oh, well, I could get some from mum and my uncle, and it seems like it might be the easy solution, and actually they need to look further down the line and have that crystal ball and see whether that's going to be the case?
Yeah, I mean, I actually think it's a good idea to almost get in bed in business with your family, and why not let them invest in your business? But you have to make sure that the basis of that investment is sound and that the terms are fair and reasonable for the risk that they're taking, and clear. Yeah, I mean, there's nothing wrong with that. It's often a good place to go if you need, £10,000-20,000 to do a project.
Well, that touches on a real key point, and it's something I've seen over the years where, forget a bank or just forget family and friends for a second. Let's say you're going into a proper joint venture with equity partners, with voting stock. Even if you have a shareholders agreement and the relationship breaks down, so then it goes into the purview of lawyers, the big problem comes, and this is where people either get the wrong advice or don't take proactive advice, is they end up all too often with a deadlock situation. Nobody has overall control. What do? You've effectively got a hung parliament, a hung board.
What do you do?
What do you do at that point? It's in the purview of lawyers.
Right.
But to prevent that in the first place, either make sure the person who you're investing with has sufficient experience to deliver the project. And if you're doing it via the company route, which is the typical way for proper joint ventures, is somebody has got overall control, 51%. And failing that, if you're all in it equally, then you need to appoint an independent board member. No vested interest per se, other than getting everybody in a darkened room with a bottle of scotch and banging their heads together until they see sense. So they have the casting vote as to what they're not interested in making money from it. They're just almost there as voting non-exec, if that makes any kind of sense.
Yeah. I mean, that's not something I've ever done. How does that work, Richard?
So now, if we're doing an equity investment, so you as a developer might have 40% of the shares, we might
I'd like a bit more than that, thanks.
Well, you're only putting in a small amount, so that's what
Right,
you're going to
go on
get. Our investors might get 60%, but then, and we would have a representative on the board, as you would, but then we'd have an independent director who is there to represent our side, the investor side, because they're taking the risk and you're doing the work. And they have control over the decisions where there's a deadlock, so they have the final vote. And it just avoids that deadlock situation.
The alternative is what's called a chicken clause. Do anyone know what a chicken clause is? A chicken clause basically means if you offer whatever you offer the other side to get out of the deal, they can have it from you at the same price. So that's another way. So it's called the chicken clause.
Pre-agreed exit price.
Yeah. So I might say, well, I'll buy you out for 200,000. Now, you don't have to agree to it. You can buy me out for 200,000. So it makes people honest. If you get money, it's called a chicken clause.
Yep.
And
Is
that's
that real
something
in
that's-
law, or did you just make that up?
No, I haven't just made that
No,
up,
I've heard of it.
Richard. I expect Ranjan's heard of it and others as well. But it's not used very much these days. But it's something that is quite it's good. It's a good clause.
I think there are multiple ways of coming up with these agreements, and I can come up with some more. But I think the important thing is that if people are thinking about investing in a developer and they aren't friends and family, it's the due diligence and understanding the risk and balancing that against the reward. I think the problem these days, and one of the elephants in the room, is social media. Anyone with a hard hat and a high-vis jacket is posing outside some development and saying this, that, the other.
And we don't know anyone here that does that.
I've got
No
a
one's
hard-
on YouTube here. Is anyone on YouTube?
There's
John
a lot
Howard
of that
property, I
about,
think.
as you know, and whether people get seduced by that, and that is their due diligence.
That's an interesting point.
I'd encourage you, if you're going to work with any developer as a passive investor, go and look at what they own, ask to see their asset and liability sheet,
Definitely.
see the addresses on them, look them up on Companies House, check they own what they say they have, because stuff can be hidden in personal names.
Yes.
There has been, people that, in the press that have a lot hidden away that they say they have hidden away and it can't be proven.
You are watching Property TV. You are watching Property TV.
You talked there about passive investors, and that was going to bring me on to what I was going to discuss, which is at what point do you agree how involved you're going to be if you're putting money into something? Because the developer might want total control.
But if you're lending the money, then you have no involvement, and you have a fixed return that they have to pay you at the end, and it's simple. So if you're new to it, that's the best way of doing it, as debt as opposed to equity. But if you're investing with equity, then you need to have that all detailed in shareholders agreement and the articles of association up front, and it's worth paying. I hate paying lawyers, but it's worth paying lawyers the £5,000 or £10,000 it takes to get that right, because at the end of the day, that is what determines what happens. And so we have a shareholders agreement, an articles agreement, articles of association, and a development management agreement, which says this is what the developer will do. This is what he can do on his own without checking with you, and if he wants to do any of these things, then he has to discuss it with you first.
That's interesting. I mean, over the years, I've had very few backers. The backers I have had have stayed with me a long, long time. But you just need to know the rules. What are the rules from the start? Yeah. And for me, it was always out there finding the deal, and my backer, as the name suggests, finds the funding, or is a wealthy family, or whatever it might be, produces the funds. And for most people, I think that's a pretty straight line to go down.
But for someone like you could actually, if you were putting money in, you bring a lot of value through that experience we know so much about.
Yes, obviously, if I'm with my joint venture fund, it's slightly different now because we put money in and we oversee the project as well. But that's slightly different. But and of course, sometimes we just use our own money to do deals as well, which is even easier.
I think one point that's worth mentioning, the way we structure a lot of deals like this is where there's multiple investors, there may be more than 4 or 5 investors investing equity, is that they have, when you structure the company, you can have stock. Just because you have 10% stock doesn't mean you have to have 10% voting rights. So the executive decision making is the people with the experience. They're the people that are being backed. So they're not investing equity in your proposition. They're doing that because you've got the experience to drive that deal forward. So you can't run these things by committee. So it's very, very important to make sure that executive decision making is confined with the people that have got the experience, even if there are many shareholders.
Ranjan, it sounds a nightmare to have more than one investor. I've never had more than one,
It's interesting
one
though, John.
partner in anything.
John, it's interesting because I would say that both you and the investor are taking a lot of risk by there being one backer with one developer. Okay, with you, it's not a big risk because you're so good.
But there's always a risk. There's always a risk in everything.
Yes, but the reason why platforms like ours exist is that it enables multiple developers to be backed by multiple backers.
No, I understand that. And
it
there's
spreads
safety,
the
and there's
risk,
safety in numbers, isn't there, Paul? I mean,
Spread your funds out, yeah.
Yeah, I think just to go back to a point that you mentioned at the start there, Richard, about sort of people doing things for the first time and wanting to raise all their money from investors. We hear that all the time. You know, people come to us all the time and they say, look, I want to get involved in property investment, but I don't have any money, but I've been told that I can raise the money from other people. And I think a lot of that's driven by some cowboys in the industry telling them they can do that. And look, I suppose in theory you can do it, but the question is, should you be doing it?
Exactly.
You know, the kind of definition of investing is that you've made a little bit of money and you invest it.
And you put it in safe hands.
Yeah, but you've actually proven that you've got the ability to make some money, and then you move into, you kind of diversify. So I think that the point there is just to be careful who you're partnering with, and if you are a beginner, I'd encourage people to go out and make some money themselves before they start trying to take money from other people.
Yeah, I couldn't agree more. I mean, it's interesting actually because, you know, there are occasions where people might be raising just say 10 or 20% extra of the debt, but they're doing it as equity and they're giving away half the profit in return, whereas they could get that money as debt, but so they know how much they're paying back and they know when they have to pay it back, as opposed to sharing half the profit. And they're giving away a lot of their hard work and the rewards of their hard work just because it's easier. And it's
I think people need to remember that debt, equity, if you put in 100 grand worth of equity into a deal, that can come down to zero. That can come down to zero.
Yeah,
Potentially.
easily. Yeah.
Particularly if it's at the top slice. The debt obviously gets paid back by selling the asset, but if there's nothing left, that top slice can be vaporized. And that's why the returns that an investor makes on an equity investment are so much higher.
Absolutely, and it's worse than that though, isn't it, Ranjan? Because not only can that equity get eroded, but you can't get a return on that equity unless there's some profit.
That's true.
So there's no good saying, well, the developer's putting in £200,000, so I can have that, because you can't have that.
Yes.
You can only get a return on your equity if there's profit.
Good point.
Quick question. We're talking about getting extra finance, whether you go for equity or debt. Is the answer to that different depending on what the economic conditions are? Is it a different answer today than it was 3 years ago?
I think it's a consideration. I mean, if you're more bullish about the profit you're going to generate because of the way the market's going, etc., then why give more away of that profit? Why not have a fixed cost as debt? And if you're less certain, then get them to take the risk and so take it as equity. But I think that's always a decision, no matter what the market is doing. I don't know what everyone else thinks. But.
And I suppose it depends what comes with the funds as well. In that, for example, as you mentioned, John, if you're joint venturing with someone and you're funding the development, but you're also providing development expertise, well, that makes a lot of sense for a lot of people.
Yeah,
adding value.
That's valuable.
Because there's value add, you're not just getting cash from someone, you're getting value add as well. So I think it depends on the person that's borrowing the money also.
Yeah.
I think the risk comes, the worry comes, the judgment call is someone, from your point of view, Richard, presumably, who's, got bank finance, put some money in, build costs have gone up, they need another 200,000 to finish the job. They can come to you, presumably, talk to you.
Yeah.
At least talk to you.
Yeah, and many other people, but I mean, that is something that we're seeing quite a lot at the moment.
And I think you'll see more of that going forward.
You might be forced to turn more to equity investors and high net worths to invest in you if the banks do close up, like we've been discussing, inflation
tighter.
rises and the banks get tighter. If you want to do a deal, you've got to find that extra deposit, that extra equity from somewhere. So the market dictates the balance to some degree as well.
Are you always in the luxurious position of being able to choose whether you go for equity or debt, or sometimes are you forced into...
By what you can get, do you mean what's available?
Yeah.
Yeah, I mean, it does depend what's available, but...
You want to look at the cheapest deal, don't you?
Yeah. I mean, I think it'd be wrong. I would never accept money from one person if I didn't have a choice from somebody else, because you're caught in a corner. I'm not pointing at you, John, but...
Nothing personal, honestly.
I'd like to always have a choice.
Correct me if I'm wrong though, Richard, wouldn't it be one of the main reasons that property developments fail, that they run over time and they run out of money and they can't get access to more money quick enough?
Yeah.
So I suppose in that case, you pretty much take money from anyone if there's still money in the deal.
Yeah, but I'd still rather have a choice. I take your point. When you're up against it, you have to get some additional funding. But I still personally rather be in a position where, okay, I'm up against it. So do I borrow from John, or do I take an investment from Nicholas? I'd like to have a choice rather than just...
There might be a TV show on that.
Yeah, there could be, yeah.
There could be. You never know.
But I think time is that, if I can just add to that point, it's not just about where do you take it from. What we're forgetting here is not just the interest rate and the cost, it's the availability of that finance. Bridge loan lenders tend to be quicker. They'll dish out the money in a matter of weeks.
And we all want an easy life when it comes to borrowing money, because whatever anyone says, you get the offer and then the work starts. You think, oh, I've got the offer. Oh, really?
Yeah, no, it's
and then it starts. And what they promise in the first place, sometimes, not always, I accept, sometimes is not what you get in the end. The one thing I would say is, ultimately, if the deal is good enough in the first place, you have lots of choices. Yeah. If you've got a skinny percentage in it of 15, 18% or something, maybe even 20 in this market, you don't have much option. And if it goes wrong, you're soon what I call underwater. You might call it something different, Richard, but funding wise, but I always call it being underwater. The people are underwater because they owe more than it's worth. And we're seeing more and more now of part finished stock, which we love to buy, where people are underwater and it's ended up with a receiver or administrator, via the banks.
And that's happening more, is it?
That's happening more, yeah.
Yeah. I'd say it's about the terms of that loan, not just the interest rate. That's key. And it's the same with any property deal. It's not always about the price. If I can get a delayed completion for 6 months, that's more valuable to me because I can get all my builders in place, I can get the tendering done, I get the planning in place. That's more valuable than the price. I'll pay more on the price to win the bid if I can get some better terms. And it's the same with finance. The terms of the finance are often highly important. Bridge loans for speed.
And the devil's in the detail, to be honest with you.
Devil's in the detail. And having a good broker, actually, and again, treating your property investments like a business, having the right broker, the right people in your team, they know what the brokers will actually lend, not what the headline rate is to hook you in.
Yeah. Also, I think something that hasn't been mentioned but worth noting is having experience of how that lender acts if you do run
Just
over
about to say
time.
the same thing.
Oh, you did.
Good point.
All right, fair enough. Well, I'll
You said it better.
words out of your mouth. So, some lenders are vultures and they want you to fail. Because they want to come in.
I don't think there's many of them. I don't think there's many of them.
Well, it doesn't happen to me, but I've been told that some lenders are not necessarily vultures, but if you do go over time, they will not give you extra time. They will foreclose and they will take it off you and they'll take your profits.
It's part of the business
So that's part of the business model. So you don't want to deal with a lender like that, obviously. And
not good.
The only way to avoid that is to look at how other people have interacted with them in the past.
Check them out.
Measure twice, cut once.
Oh, that's a nice saying, yes.
On that happy note, we are out of time. Thank you very much, gentlemen. So I think it's pretty clear you need to read the small print carefully. If you're going for an equity deal, make sure you've got your agreements carefully worked out.
Yes.
Fair point?
Fair
Excellent.
point.
All right, thank you ever so much. Until next time, bye-bye.